Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday, the 18th of May 2021, and we're reporting that gold and silver prices are beginning to surge. So let's take a look. Yesterday we published a video entitled Gold and Silver Price Optimism at Last, where we saw and highlighted that gold prices had risen to $1,852 and silver to $27.71. In that video we pointed out that there was increased enthusiasm for precious metals once again for a range of reasons, and that as Bitcoin and cryptos begin to tumble and equity markets falter, then precious metals will start to come into favour again. Now, we commented on cryptocurrencies in a video we also produced yesterday entitled Bitcoin and Cryptos Crash Thanks to Elon Musk, What's Going On? And we've placed links to both the gold and silver optimism one and the crypto one in the description box below. We do urge you to listen to those videos if you get a chance. Well, yesterday's optimism has already begun to be translated into price rises. At the time of writing, which is 0853 GMT+1, gold has now risen to $1,870, some $26 higher than Friday's close. And silver stands at $28.54, which is $1.10 higher than Friday's close. Now we shall look at the reasons for these rises, but certainly the quite dramatic fall in the dollar over this past 24 hours has provided a tailwind behind dollar-denominated commodity prices. Yes, yesterday the dollar spot index stood at 90.29, but has now fallen below that psychologically important level of 90 and is currently 89.88. And this move is important. Chris Vermeulen published an interesting article on FX Empire just over an hour ago, and here is an excerpt from that article. Quote, headline, quote, US dollar and currency correlations suggest big advance in metals is pending. The primary driver of this move is the declining US dollar, not the move higher in the Euro USD or Japanese Yen USD. These other currencies are simply barometers of the global perception of the strength of the US dollar. A weakening US dollar will usually be prompted by a moderate advance in gold prices. We believe the correlation between the US dollar value, above or below the 85 to 86 level, as well as the correlation of the strength of the Euro USD and Japanese Yen USD in comparison to the US dollar, may prompt a change in how gold reacts to moderate trend bias, as well as how gold reacts to changes in the US dollar trends. The bias trend of gold within this extended market cycle phase tends to mitigate gold price volatility as the US dollar temporarily bottoms or bases and starts to rise. This suggests a broader rally in gold throughout this new market cycle phase and may extend much higher than many people expect. Side heading US dollar flirting with massive price decline once $89 is breached. One key factor that is likely to drive this new advance in gold and silver: the US dollar trend. I am watching two critical support levels in the US dollar right now, $89.70 and $89.20. If the US dollar falls below either of these support levels, gold will likely advance higher as the currency depreciation cycle phase appears to be continuing to engage as we expect. Remember, the key level for the US dollar is that 85 to 86 level. The closer we get to those levels, the more conviction traders and investors will have regarding the advancing precious metal prices. The 89 price level for the US dollar is likely the breaking point for this cycle phase to really break loose, so watch that level very closely. What is important to understand about this potential cycle phase shift and new precious metal trend bias is that it may take many weeks or months to complete before the bigger rally really starts to build momentum. Yet the evidence is starting to build that a decreasing US dollar trend may prompt this new cycle phase shift in the currency correlation and may prompt a big shift in how precious metals and miners start to rally higher. Right now we're seeing gold and silver start to shift into a new bullish trend bias. Therefore, we may be starting to see a shifting in expectations, which is very similar to what we saw in 2000 to 2005, just before gold exploded higher, unquote. Now, Chris is referring particularly to gold here, but the same applies to silver. But with the added potential momentum, especially if global economic trade recovers. Now, we pointed out in our weekly gold and silver update, which we published on Sunday, and we put a link to that below, that we expected gold to trade between $1,775 and $1,875, but extended our outlier limits to $1,700 to $1,950, and silver trading between $26.50 and $28.50, with $26 to $29 as outliers. We're still comfortable with the gold price prediction, though we may indeed move into outlier territory, and silver really depends on the next day or so, and may move to the top of our outlier band and could, with a favourable wind, even exceed it. It's a little annoying to say the least that the one weekly update, where we are quite positive about gold and silver prices, is the video viewed the least out of all our updates over the past 12 months. Oh, the irony. Inflation is a concern, and as we mentioned in our video yesterday, the Fed has confirmed that it will hold interest rates down even if inflation rises in the short term. This will undoubtedly cause tension and concerns, and let's just take a brief look at an article published on Bullion Vault yesterday concerning this very subject. Bullion Vault article dated 17th of May 2021. Headline: No inflation if you don't eat, sleep or travel. Yes, inflation is here. It is showing up all over the place. In commodities, food, housing and fuel, writes Bill Bonner in his Diary of a Rogue Economist. I recently received this list from my Bonner-Denning letter, co-author Dan Denning. It shows the increases over the last 12 months in these commodities. I won't read them all, but lumber up 265%, Brent crude up 163%, copper up 83%, soybeans up 72%, silver up 65%, natural gas up 43%, coffee up 13%. Of course, if you don't eat, live in a house or go anywhere, you might not even notice, but the rest of us should prepare. One of the things we've been thinking about is how hard it is to think about inflation. Everywhere you look, there is someone telling you not to bother. Treasury Secretary Janet Yellen has the economy figured out. The Federal Reserve has the financial system under control. The Biden team is busy building a better world for us to enjoy. And if you want to get rich, you just wait for Elon Musk, the business mogul turned Twitter sensation, to mention something and you buy it. What a surprise it will be to us all when the whole fantasy collapses in a heap. And yes, that's what you should expect. Coming soon is no ordinary cyclical downturn in which interest rates head up and stock prices head down. In a healthy economy, you might expect that. Things to go up and down. With stock prices at or near an all-time high, a bear market should come along in the normal course of business. Nothing to get alarmed about. So should the bond market begin a long-term trend of rising yields? They've been going down for the last 40 years. It's about time they turned around. What we're looking at now is something much more sinister. Many years ago, we guessed that no pure paper currency could survive a full interest rate cycle. From bottom to top and back to bottom, a full cycle puts the monetary system, as well as the moral strength of the people who run it, to the test. As for the latter, we have low hopes. We've already seen the authorities pump up the money supply in 3 panics so far this century. They've brought the Fed's balance sheet to a total of $7.8 trillion. Each time they were able to drive yields down a little further. But the bull market in bonds seems to have hit bedrock on August the 4th, 2020, with the yield on the 10-year Treasury bond at 0.51%. Since then, yields have been rising, and now the 10-year trades around 1.6%. Whether last August was the final bottom for yields, we don't know yet, but sooner or later yields will rise further and things will start to get tough. The US has total debt of more than $80 trillion. Even a small increase in interest rates will make it hard to refinance. Consumer prices will rise too, with the consumer price index headed over 5% and then over 10%. Not necessarily tomorrow, but it will happen. Meanwhile, stocks will fall, the economy will go into a recession or depression, and then the moment of truth will be at hand. In another panic, with all hell breaking loose around them, the Feds will have a choice to make. They can protect the dollar and let the correction continue, or they can pump more money into the system and let the dollar and the current paper money system die. This is the sort of choice that a gold-backed currency, as the dollar was until 1971, was meant to avoid. People found out centuries ago that humans couldn't be trusted with money. In a moment of stress or greed, they would print more of it. But you can't readily increase the supply of gold, so in a crisis the authorities would have no choice. They'd have to forego their hopes of being lauded as a hero and ignore the cries for help. They'd have to admit they have no help to give. But this time it's different. With a few keystrokes, the Fed can create trillions in new money, and in the next crisis, as in the last, they will not hesitate. Even fairly routine setbacks for the stock market in 2008 and again in 2020 were enough to send the Fed into a money-printing paroxysm. Worldwide, over the last 12 months alone, central banks and central governments provided some $27 trillion in additional liquidity through deficits and money-printing credits. So try to imagine what will happen next. The next crash could wipe out the crypto market for $2 trillion in losses. And merely bringing US stock prices down to historically more normal price-to-earnings levels would mean a loss of at least $15 trillion. Imagine how Wall Street would shriek and howl. Imagine how Congress would demand action. Imagine the columnists, the economists, the lobbyists and the wags all screaming for more money. Imagine Yellen and Fed Chair Jerome Powell, their knees quaking, their backs limp and their minds mushy. Could they defy the financiers and the federales and stand behind the greenback like former Fed Chair Paul Volcker did? Would they stop the presses and let the chips fall where they may? Not a chance. They would print more money. Inflation be damned. And soon the graveyard of fake money would open its gates. There, greeting the post-1971 dollar, will be the German mark, the Zimbabwe dollar, the Argentine austral, and hundreds of other failed currencies. End of article. Well, that's something for us all to consider, isn't it? Are we at that point of collapse yet? No, but the warning signs have certainly changed from amber to red. Gold and silver had a period of consolidation, and we shall now see if they will break to the upside, or if the money managers can keep these prices contained. We have stated in many of our reports that the traditional stock market adage, vested in decades of experience, is sell in May and go away. Are we about to see these declines happen, or can they be extended further? Only time will tell, but at least we have all been warned. What are your thoughts? Do share them. Meanwhile, thank you so much for listening. If you haven't already done so, please subscribe to our channel, not forgetting to press the bell sign so that you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.